At the beginning of the year, the Fed came out and said that they will not be raising interest rates or lowering them because what they see in the economy is that everything's great. Just this past month, not only did they lower the interest rates, but they said that they will continue to do so if they see fit. On top of that, they added quantitative easing. That's terminology that we have not heard since 2008. So to discuss all this on top of rent control, how will, if you go to purchase, if you go to refinance, if you go to grow your portfolio, how will the banks be looking at rent control now differently when they lend you money? So to discuss all this, we have Gil Figueroa. Gil Figueroa is the CEO of First Commercial Capital. He's been a commercial lender for the past 25 years now. And because he's a commercial lender, his touch and feel is across the board of what he sees on the market. So with that, please help me welcome Mr. Gil Figueroa.
Thank you, Deepan. Good morning. How's everyone? Good morning. How's everyone? All right. So Chris mentioned something interesting in the beginning. He said that in 2008, he sold properties at $100 a door. Well, what is that same property worth today? 2.5 times more? How many of you, show of hands, planned and knew that was going to happen? No. So how many of you feel very lucky that it happened? Okay. We're going to talk about luck, and we're going to talk about, a little later, we're going to circle back to luck. So I'll tell you a little bit about my firm. We've been a mortgage broker for 25 years. I love being a mortgage broker because lenders have different appetites. And every time a lender changes their appetite, we're on the cutting edge, and we find the best lender for your situation at any given time. So currently we're working with a lot of lenders that are pricing larger loans much more aggressively than anyone else. Right now we have rates as low as 3.47 on a 10-year fix. So that's an aggressive product. They're looking for good product and a good client. The beauty of sourcing loans is we know every lender's underwriting criteria, what they're looking for, and how it can benefit you. So currently we all know about the rent control challenges, and now we're dealing with that. Has it affected lenders? Absolutely has affected lenders. So the larger lenders, for instance, the Chase, Wells Fargo, US Bank, are doing retro underwriting. Now, what does that mean? If you bring them a file today and the rents were raised after March, after March, they're going to go retro to before March to underwrite that file. What that means to you is they're going to be very, very conservative on pricing and loan amount. So in essence, what they've done is lowered their debt service, okay? Us, on the other hand, we have lenders that are more aggressive and are looking at this in a little more common sense approach, especially if the rents weren't raised. They're looking to underwrite based on forecasted rents within the allotted maximum of 5 to 7%. So we hit an all-time low. At that particular time, we sent out a lock criteria. We asked all our buyers, you need to lock, we want you to lock. Matter of fact, I believe there's 2 or 3 in here that took advantage of the lock, and we locked at 3.40, and within a week of our timing, the rates had jumped to 3.75. So we forecasted that market as well, okay? What's next? On August 16th, Chris asked me to do a little webinar. And in our webinar, we discussed the market conditions and where we're at. At that time, I saw that we hit a top, and I felt rates were going to do a reverse, an increase. Not a giant increase, but an increase. We were right again. That market moved from a 3.4 rate on a 5-year multifamily building to 3.75, and some lenders as high as 4%. So where are we now? If you notice on the chart to your right, we bounced up, we bounced down, which means rates went up. And now recently in the last 2 days, we bounced up again, which means rates are down again. Now we didn't break a threshold. So based on what I'm seeing in the market, my advice is to lock right now, okay? So even though you're hearing the market tell you rates are going to 0, the chart is not telling us that. The chart is telling us there's tremendous resistance at that level, and we keep bouncing from that top. So the chart is telling us that rates are going to blip up. How high? We don't know yet. So there's certain thresholds that we look at. So if we get to a certain yield, which I think is about 2.75 on the 10-year Treasury, and we break, we could be headed for much higher rates. So this is the time to lock your rates. All right, state of the market. So January, the Fed's position was they were happy with the current economic growth, inflation, unemployment. They said they wouldn't lower rates, and they might not raise them. Okay? At that time, there was no talk of Fed easing. As a matter of fact, they, until that time, were stopping quantitative easing and discussing lowering the debt on the books. So that was the objective. Well, what just happened? The Feds did an about-face, a complete 180-degree turn. They turned completely different. On September 16th, they lowered rates by a quarter. Now, the part that's mysterious is that at the same time, we had the repo market that Steve was mentioning come up short. Now, it didn't just come up short a little bit. This is interbank lending between banks on a short-term loan. Usually these loans are one night. So the repo rate was trading between 2 and 2.5% on the internight trade. The bidders were not existent. The bids went all the way up to 10%, and no one bidded. It was mysteriously shut down, and a mysterious buyer came in and bought at 2.5. We know who that buyer is. It's the Fed. Now think about that. These banks were offered a 500% return for one day, greater than the 2% they were being offered, yet no one took it. Now, why wouldn't they take that? Sounds like a liquidity issue in my book. So we're dealing with a big problem. The question is, when does this problem bubble up and explode? We don't know. So Japan is continually having for 10 years. They just keep adding liquidity. On our part, we're adding it. As a matter of fact, by October 10th, which is when the Fed say they will stop this liquidity, they've borrowed $1 trillion into our system. The last time this happened, as Steve mentioned, was 2008 during Lehman Brothers, when Lehman Brothers was insolvent and pushed to declare bankruptcy. So, folks, whether we know it or not, we are in Q4. Maybe they're not calling it that yet, but we are most definitely in Q4. Okay, what does this mean? Well, we talked about that. Decade long in Japan, still moving forward. Japan is still moving forward somehow. Some would say they're just treading water. Not much growth, no GDP growth. Where are we at on market rates? If markets cannot bid because of lack of liquidity, can rates go down? Let's talk about that. I say that's an impossibility. If there's no funds to buy bonds, rates cannot come down. Matter of fact, bonds will be liquidated. So there's many speaking of a bond bubble. The interesting part of our system right now is we're dealing with many bubbles, not just a bond bubble. So right now, we are in a situation where, frankly, it's above my pay grade to explain of what to do or what not to do, per se. But when we're in these situations, I always look for one main indicator. And the one main indicator I look for is, what are the big boys doing right now? What are they doing? Well, Mr. Buffett has $122 billion in cash, the most he's ever held. Now, do you think he buys bottoms and sells tops? I would say so. I say he's good at it. Other rich are hoarding cash as well. So with political, geopolitical, trade, economic credit risk, everyone is getting liquidated. So what are you doing these days with your portfolio? What are you looking at? Most apartment owners that I meet with have very little liquidity. They have $20 million net worth and they have $50,000 in the bank. And I'm like, you can't run like this. You can't run this operation. If there's a shortfall, you're going to have a huge problem. So Buffett said it best once. He says, you don't know how everyone's dressed until the water resides. Then you'll see who's swimming naked. So I believe that's the truth. With that being said, what do? I believe we need to have an investment game plan, unlike ever before, okay? So in the beginning, I asked, how many of you felt lucky? Everyone did. How many believe that luck will prevail in the future without a plan? So lucky's over. It's time to plan. Chris has amassed the top guys in the field here, whether it be in mortgage, law, forecasting, and tax implications. Use us. Be ready. Get a game plan. Every asset you have should have a specific game plan. How long will you own this asset? How will you pass it through to your heirs? Every plan. Do you leave the state? Do you buy in a different state? Do you exchange? Do you liquidate? Do you do cash out refi? Do you get strong? What's the old motto? Buy when there's blood on the streets. That's always worked. If you have the liquidity, you can buy. If you don't have the liquidity, you become the blood. So, with that being said, I believe there has to be a specific game plan. There's a lot of issues moving forward. We have talk of Prop 13 being changed. We have volatile interest rates. The market's going to be moving quickly. And we have drastic changes in lending. Like I said before, the lenders are changing. Some of the larger lenders are becoming more conservative. Chase, for instance, had a 115 debt service. They dropped it to 120. So now, raised it to 120. So they're lending less. Okay? So they're being a little more conservative. So with all these changes and a potential black swan event, which is liquidity, we need to be prepared. With that being said, Chris has amassed the best team. Take advantage of us, set an appointment, sit down. Let's analyze each and every asset in your game plan. I thank you for your time.
I'd just like to thank Chris German and his team for the event today. The luncheon was definitely super helpful in helping me understand the rent control law and how we're going to be dealing with it, and also the issues about the market in general. So thank you, Chris, for holding this. This is my second time coming, and every time it's super helpful.